Romeen, welcome to the show.
Hey, Justin, thanks for having me.
Yeah, where I want to start with today, there's a lot of different ways to go with your background experience. One thing I'm curious about is you are a founder and also an investor. Why start a podcast? I have to ask about that in the first place.
Yeah, it's funny because when I started my podcast, it was like 3, 4 years ago or so now. Podcasting wasn't like the thing, right? Everybody didn't have a podcast. It wasn't super popular, et cetera. And I'd say I kind of started it honestly with a little bit of that like naivete too, right? I didn't have this like grand vision of I want to build a community and a following and it's content marketing and this, that, and the other. I actually just thought of it honestly as like an easy hack to meet and talk to interesting people. And so for me personally, I didn't really care if one person listened to it or a million people listened to it. I just wanted to talk to the most interesting people in the world. And I was fortunate early on to kind of get some really interesting folks like Keith Raboy or the former CEO of Toys R Us, CEO of Boston Beer, Andrew Yang before folks knew who Andrew Yang was,
Yep.
and had just a lot of interesting people that came on. And then that was actually the flywheel to get more interesting people to come on, right? And so I was able to share folks that I had on before, and that really started a really big flywheel. And kind of 115, 120 episodes later, I've just been lucky to have a bunch of really interesting people on, and then most importantly, really just build a lot of relationships with many of those people,
Yeah.
right? Do deals with them, do partnerships with them, kind of on and on. So I kind of started it, I'd say, from a pretty innocent place, like not a grand strategy or so. And I think honestly, that's what's kept it a lot of fun and a lot of and has kept it pure and allowed me to keep it going because I've really never had a big expectation out of it. And so I have this kind of thing where it's like, happiness is really reality minus your expectations. And I think if your reality is always better than your expectations, like you're going to be happy. And so it's been a lot of fun.
Yeah, I asked that because I know how it can impact people creating stuff, creating content, also to your point, relationships is everything in this game, especially investing. And so from that too, just diving a little bit deeper into that, like I know you mentioned like some co-investors or other, deals have come through that, but take me through some of the impact. I know it's not been necessarily your main focus, you're doing for fun and also to enjoy it and meet people, which is also like I've done just a grind podcast before, but take me through kind of the impact of that on your career, life, et cetera.
Yeah, I mean, it's had a huge impact, and I think it's one of those things when you start projects or you do things and you actually do it for like the love of doing it or the actual kind of like purity of enjoying it. Typically, like better things come about than if you are trying to get some sort of end, goal or so out of it. So yeah, I mean, a lot of the things you mentioned. I mean, I've invested in over 50 companies now. A lot of those have come, from many of those relationships. We've had athletes, Olympians, et cetera, on the podcast as well. We did something really cool in LA, late last year where we had, we brought together about 80 folks, NBA players, other athletes, founders, et cetera, and just, kind of had a 1 day kind of summit and get together with tons of interesting people. Um, and then, just advising a lot of startups also, right? Like whether it's taking advisory shares in companies, just helping folks out. I'm on the advisory board of 2 SPACs. So a lot of just interesting kind of organic things, all the things that you would imagine, right, kind of come, I think, with being, helpful and in the ecosystem and having real relationships. I'm a big believer of if you surround yourself with interesting people, interesting people do interesting things. And I think if you can, not ride on that wave, but you can also contribute kind of value and interest to that equation, then, you know, a lot of this is serendipity and kind of creating the surface area of your own serendipity. So yeah, I mean, it's been a huge, huge impact. I think, you know, 12 months ago, I probably had 1,000 followers on Twitter, and now I have almost 100,000. And the surface area of just that reach and that distribution, and the podcast flywheel, and having invested in a bunch of companies, and fortunately a bunch of companies that have done very well, it just all creates this kind of organic flywheel of sorts of it's easier to get into the next company, or founders will return your call or your DM or whatever it is. There's more folks you met through the podcast, et cetera, that will bring you into opportunities. There's different ways to do things, at scale. So it just keeps kind of amplifying upon itself. But it's all the core things that you mentioned.
Yeah, I heard an interview recently. I forgot who it was exactly, but they were saying basically in creating different things on the internet and everything, it's like, especially as an investor, you're trying to find like that needle in the haystack, right? But as you create things, you essentially had the needle in the haystack come to you, which is like the perfect way of kind of putting it. And one of the things you mentioned there with the Twitter side of it, we'll get into a lot of different investing things too, but with the Twitter side of it, what has been your approach to that in terms of how you go about that? You've had a lot of things go viral in terms of a lot of reach, I should say. Like, what has been your approach to that as an investor, as a founder? I'm curious on how you use the platform, because I know how powerful it can be, especially in investing, but I'm curious as how you kind of approach that.
Yeah, it can be. I mean, it's really powerful, right? And I definitely didn't understand the value of that. Otherwise, candidly, I think I would have started doing it a long time ago. It's really valuable when you have distribution and reach. I mean, if you think about kind of investing at the end of the day and getting into companies, right? Founders are really looking for like check to helpfulness ratio, check size to helpfulness ratio, right?
Yep.
And it's really hard to kind of come in as an angel and say, hey, I can help you, with strategy, or I can connect you with people, so on and so forth. Like, yeah, maybe that's all true, but the best companies and the best founders don't really need your help, right? If anything, they kind of need you to stay out of their way. And
Yeah.
when you have really top tier firms coming in, they're playing the same playbook, right? Hey, we can introduce you to XYZ. Hey, we're gonna give you all this value, et cetera. We can probably have a separate conversation of whether that actually value pans out or not, but it's the same kind of thing. And so I think if you're trying to play the same playbook as everybody else, you're going to lose, right? Because it's kind of the same thing. Like if you're starting a startup and you're trying to play the same exact playbook as an incumbent, you're just going to lose, right? And so I think what you have to find is you have to find kind of your different, your mojo or your different kind of shtick. And I think it's actually really helpful when you're trying to get into the best companies where you can just actually have a very clear value proposition for the founder, right? Hey, I can help you with a bunch of this other stuff. And if you want intros and this, that, and the other, like I'm kind of there as a sounding board. But
Yeah.
really it's two things. One is I know I can help you on distribution and reach, right? And I can help you with, organic virality or organic, reach in a trusted way because I have an audience that trusts me, right? And there's a credibility behind that. So that's one piece. And then the second piece is, you know, I can be there for you as a sounding board, right? I think a lot of the understated value of angels often is, your board and your venture investors, you have a different set of incentives and incentive structures with them, right? And so, while you may try to be, super tight at the hip with the board, et cetera, who knows, right? If the company's not doing well, you might have to go to those same people for a bridge round. And you may not want to share, certain information, at least in the first iteration as it is in your head, right, with them as it's stated, right? And so what I like to do is really actually say, I can help you a lot with distribution. And by the way, like there's a ton of founders that I've invested in, fortunately, without my help, have done incredibly well. And so, there's a bunch of folks that I can kind of give you as references that I'm a good person to have in your circuit, right? And I think at the end of the day, that's what most founders are really looking for out of angels. I think often, we can kind of propel these like really large visions of what is the value add and the this and the that. And I think if you're a strategic angel, it's really like, can you give something that actually moves the needle for them in a unique or interesting way? And are you just somebody that they want in their corner, right? And on the journey. And so it kind of goes back to what we were talking about a little bit earlier, which is I think if you do things a lot for kind of like the purity of doing them, right? Your question was kind of very specifically around, I know I gave you a little bit of a roundabout answer, but your question was very specifically on like, how has the approach to Twitter been, right? There hasn't really been an approach, right? And I think that's actually why there is that virality or organic reach. I mean, you see people on Twitter all the time that are like, that get 20, 30, 50,000 followers, 100,000 followers, whatever it is. And then they have these threads that also go viral. That's like, I grew from X to Y in, 5 months or whatever. And this is what I
Yeah.
did. And then they lay out this like super scientific methodology, right? I reply 10 times a day. I post 3 times a day, this, that, the other. That hasn't look that works, right? And like clearly it works and there's nothing wrong with that. That hasn't been my approach because it doesn't feel authentic to me, right? Like it's
Yeah.
my approach is actually, I'm operating, I'm investing, I'm learning these things. Some of these things I'm learning on the fly. Some of these things maybe I have a little bit more experience than other people do, and I want to share those insights back in an accessible way for people. And I think that's how you actually build, when you look at top line numbers and kind of growth trajectory, maybe a little bit slower of a way to grow. But I think the loyalty, the trust, et cetera, that you manifest with, your audience, et cetera, is just it's a lot different, right? So,
Yeah.
so my approach has been, it hasn't been kind of super scientific. Now, as you do these things, you learn tactics and you learn how things kind of hit and stuff.
Yeah.
But my approach has really been like writing is pretty therapeutic for me, right? As an operator and a CEO. And If I can share those lessons, great. I enjoy doing that, and it's a way for me, when you think about things or you talk about things versus when you write them down. When you actually write them down, you have to kind of snuff out the logic, right? Like you can't get away with just like saying something at a high level. So I do it for that reason, and fortunately, it's really worked.
Yeah, and there's a great book called "Show Your Work" by Austin Kleon, and I love that because it is that exact thing. It's like as you're going operating a company, making investments, you're sharing those things you're learning along the way, and that always resonates. I think that's the same thing with like Gail at Vitalize. Like she's sharing insights from having conversations with founders every day, and like that is real, tangible things that like she can own because that's her actual conversations that she's having, and you can leverage that to obviously grow and people kind of understand what you're doing and trust you and everything is like that. But one of the things you mentioned a little bit back is you did like 50 investments so far. Like, what got you into angel investing in the first place?
Yeah, I think the biggest unlock for me was, so I'll say kind of, I think when you're a founder or you're an operator, whatever it is, talking to other people is actually really helpful, right? Like other
Yeah,
operators, other founders, other senior folks, et cetera. It's really, really helpful. I think at the end of the day, whatever space you're in, if you're running a business, like a business is a business at the end of the day, right? It boils down to the same equations. How much cash do you have in the bank? How fast is your revenue growing? Is it actually good revenue and profitable revenue? You've got customer issues, partner issues, employee issues. I mean, it's all the same things at the end of the day. Now, there's nuances, right? If you're running a consumer company, enterprise SaaS, like hardware, this, that, the other, there's obviously all sorts of nuances. But at the end of the day, businesses boil down to like the pretty same fundamental elements. And so for me, I just, I like being in the community, et cetera. I really enjoyed talking to other founders, and especially founders that were, doing quite well and learning from them. Right.
yeah,
And oftentimes I think what I found in our conversations was I would go into the conversation wanting to learn from them, and I did learn from them, but sometimes there were things they learned from me, right? And there was a little bit of that exchange, and there were a lot of those companies that ended up doing extremely well, and then I kind of said, well, wait a minute, there's kind of a less organic way to keep in touch or develop a relationship. Hey, this was a great conversation. Maybe we'll get coffee in 6 months, right? Something like that.
yeah,
But is there a relatively low risk, type of way to actually get involved and get more deeply engaged, right? And I found that through angel investing, right? And I think it was, if you already have the relationship with this founder, you're adding value, they're adding value, you like each other, you believe in the business is doing well. Like, why not put some skin in the game? Why not ask to put some skin in the game? And enjoy some of that, upside and being a part of the journey and so on and so forth. And so that was a pretty big like mental unlock for me, probably 3, 4-ish years ago. And that's really when I started more actively investing. And I'm so glad I did, because the money aside or the economics aside, et cetera, obviously there's a part of angel investing, which, we all, want to hit big returns, and that's all fine and well. But I think it actually builds a much better bond and a much better cadence, right, with those same people that you want to keep in touch with or kind of be
yeah,
along for the ride. And kind of the way I think about things is, I'm 32, and the way I think about relationships and just like this journey, et cetera, is, we're going to be doing this for the next, hopefully 40, 50, plus years, right? And so relationships are really like long-term things. And it's really cool to be a part of the journey of folks that you see they're kind of hitting that inflection point. And they're hitting that inflection point right now, but just imagine where they're going to be in 10 years or 15 years
yeah,
or 20 years. And so, kind of keeping that circle tight knit and doing it in an organic and a true way, not a transactional way, right? Of having real relationships, real friendships, et cetera. I'm just a big believer that it keeps increasing that serendipity or that surface area of serendipity, right? And everything in venture or everything in tech is so asymmetric, right? One
yeah,
bet, one outcome, can underwrite or subsidize 50 outcomes, right? Or 100 outcomes, 100 bets. And so the mindset of saying, how do I get into the game and not just observe the game from the sidelines, was a big unlock for me. I spent a couple of years consulting at McKinsey, and the ultimate, I think there's a lot of great things about McKinsey. There's a lot of not so great things about McKinsey. But I think one of the big pieces that people that come from those backgrounds, or even great investment banks or law firms or whatever service providers, basically fall into the trap of is, um, you give the advice, you build the relationship, et cetera, but you don't really have any skin in the game, right? And all the upside and all the like enjoyment and fun, I think, accrues to people that have skin in the game.
Yeah.
So it was kind of an unlock, but that was the way I approached it, and that's the way I still think about it today.
Take me through that. So going from that, starting with angel investing a few years back, and then you mentioned on Twitter, like basically the last year, you've like doubled down essentially. Why in the last year? Is it really more of a matter of just having capital? You want to have more time? Like what was it that kind of unlocked that to be able to do more of it?
Yeah. Capital is definitely part of it, right? I mean, I think when you have capital, it allows you more flexibility and freedom to do things. Now, I will say, like, there's a lot of people on Twitter that, and I think this is super productive and constructive and thoughtful, actually, which is there are a lot of people on Twitter that actually break down this nomer or this idea of like you have to have capital to invest a ton, right? I mean, there are founders in great deals that are taking 1K checks, 2K checks, 5K checks, right?
Yeah.
And things like AngelList and stuff are helping do this, right? It was impossible 3 years ago to do that, but founders are doing that now, right? I wouldn't say every founder's doing it. Like I don't, I wouldn't bank on that as necessarily being a strategy, but I think what's basically happening more and more is capital is not becoming the barrier to get in, right? All these scout programs and SPVs and rolling funds and this, that, and the other are ways for people that may not have the capital right now to be able to augment and say, well, I have the access or I have the value or I can spot these things. How can I actually get into them? So capital has been, partially an unlock for me. But I would say just for everybody listening, especially aspiring folks, don't mentally think of capital as a lock, right?
Yeah.
The other piece I think is just you have a better idea of what you're doing, right? And so like you've seen a lot more, you have better judgment, et cetera. And so I haven't necessarily doubled down on the number of deals, but I've definitely doubled or in some cases tripled and quadrupled down on the amounts per deal, right? And I think that also is a matter of conviction. It's a matter of confidence in your own judgment, but it's also a matter of, I think, when you're an angel and you don't have to be branded kind of as an early stage VC or a late stage guy or a crossover person or this, that, and the other.
Yeah.
You can kind of underwrite however you want to underwrite. So like there's a bunch of companies I've underwritten into that are already at $1 billion valuation, but and I'm not expecting to 100x my money there, right?
Yeah.
There's seed checks in which I want to ideally 50 to 100x, and kind of my seed portfolio I underwrite in a slightly different way, right? And so there's kind of a mix and kind of gamut also of, I think, yes, having more capital, et cetera, is great, but it's really having more judgment, right? More judgment, more connectivity, more conviction. That's driven kind of that amplification and I think the other part is like when you see companies you've invested in and you had the benefit of looking for 3, 4, 5 years, right, and seeing the trajectory and how those companies have played out. You can also then extrapolate that learning to new companies that you're looking at today. It's very hard, I think, if you haven't been a part of like fast compound growth in some respect, whether that's investing in a company, being a part of a company, founding the company, whatever it is. If you haven't been a part of that or seen that in any respect, I actually think it's really hard to mentally extrapolate that, whoa, in 5 years this thing could be massive, right? And so
Yeah.
so that's been a big part of it. Having some capital, yes, but the judgment piece certainly.
On that too, take me through like the allocation in terms of how you look at that, because you mentioned, you're investing in different stages. You can be opportunistic as an angel. For you though, what does that look like in terms of how you're allocating? What types of things you're looking for in companies? I'm just curious on how you kind of have viewed that over the last number of years.
Yeah, I mean, I think there's two elements to your question, Justin. One is like the pure like allocation part, which is like more of like a personal finance kind of perspective or decision,
Yeah.
right? So I can walk you through that. And then I think the other part is like the evaluation part, right? Like what are you looking for
Yeah.
literally in the company to make the decision? So the allocation part, and everybody has different ways to think about this. I mean, I think about this as like, you know, 15 to 20% of my net worth I want in like very high upside, very asymmetric. If it goes to zero, it goes to zero, but very, very like very high risk, very high reward, right? And the other, 80 odd percent, I'm actually pretty conservative, right? I'm like a passive index fund kind of person,
Yeah.
right? Et cetera. And I think that's important also at different stages of capital accumulation, et cetera, too, because I think there's something very real of like the joy of getting more actually starts to become less and less than the downside or the pain of losing a certain amount, right? Because um, there's only so much you can consume, right? So I think from a kind of allocation perspective, that's how I kind of think about it mentally. Now that 15-20% is a big broad bucket. That can be crypto, that can be early stage stuff, late stage stuff. It kind of smatters, across the board, right? But I kind of think like 15 to 20%, have risk, bet on yourself, so on and so forth. And then, kind of breaking that down further, I don't have like a really good logic of like, of that 50% is early stage, 20% is later stage, et cetera. That's where I think I go into actually the latter part of your question, which is the more opportunistic part, which is looking for companies and looking for things at inflection points. So I think one of the biggest, startup myths or so, and this market is a little bit different because valuations have gotten pretty high, but the idea of like, all the returns are in like early stage. The earlier you go, the better the returns you're going to get, right? And look, on an absolute basis, is that true? Mathematically, obviously, right? If you invest in something at a $10 million cap, $5 million cap, whatever it is, you ostensibly have, the highest upside.
Yeah.
But when you look actually from a returns perspective, et cetera, you know, I think there's so many companies now that are valued in this like $500 million to $1 billion range that are hitting really nice inflection points, or like the absolute multiple. Like, yes, all of these companies are not going to become $100 billion companies,
Yeah.
obviously,
Like Stripe.
right? Yeah, exactly, right. But a lot of these companies are going to become, 4, 5, 15, et cetera, $1 billion companies with the relatively clean line of sight on how they get there if you're just patient over the next 3, 4, 5 years, right? And I'm talking adjusting for like, the multiple compression we're seeing in the market right now and so on and so forth. Like, there's a pretty clean line of sight that like these companies are growing, 50 to 100% year over year. They have really good economics. They have scale. There's a clear line of sight here into how can this company 10 to 20x, right? And I think when you think about it like that, or you see enough opportunities like that, and with significantly lower risks, by the way, right? Because not only is it the risk of, this company doesn't materialize, but it's also, the capital structure, right? So when you have preferred stock and you have liquidation preferences, and let's say you're betting on a company that has, $500 million valuation or $1 billion valuation, and that company has raised, 100 million or so, remember, as long as that company sells for 100 million, you're getting your money back, right? And look, there are crazy deals happening all over the place where companies have 5 million in ARR and they're getting valued at $1 billion. I'm not talking about those companies, right? I'm talking about the companies that have, 50 to 100 million in revenue, have great economics, are maybe not growing as much of a rocket ship, but are still growing, 50% year over year, et cetera, which, by the way, for that scale is pretty damn good, right? So there's a lot of structural opportunities that become really interesting when you're evaluating to say, hey, I want to get into more of those because maybe the absolute upside is not as high, but the risk is much lower, and ultimately the game is a risk reward game. It's a pendulum, right? And so like, if you could tell me, and this would be, to be clear for everybody listening, this would be insane, that hey, I could get 25% returns annualized for the next 20 years. Insane. Obviously, extremely, extremely high benchmark, right? But there's two ways to think about that. One way to think about that is like, I'm going to make a bunch of early stage bets and I need 1,000x outcome and a whole bunch of others that lose so I can get to that. That's a very, very wide range. Imagine if you could kind of tighten the band to say, okay, the upside is smaller, but the risk is less and less. And so like you're tightening the standard deviation. And I think if you can tighten the standard deviation and get the same ultimate outcome, like that's the outcome you want to go for, right? You always want to go for like, how do you get to that bar you want to hit, but with way less standard deviation? Because the variance then on the upside or the downside, if you underperform or overperform, right? Let's say underperform. If you underperform, you're still going to be like in really, really good range. Whereas in super early stage, the variance can be incredibly, incredibly wide, right? So that's kind of the way I think about it. Like I think all the elements of like, what do you actually look for are kind of the same things everybody talks about, right? Market, team, product. I think you obviously have less information when you're early stage. You have a lot more information when you're later stage. Later stage, you're really underwriting like, you're really underwriting like the structure of the deal. When is it going to go public, or when is there going to be liquidity, and the valuation, right? That's really, you're focusing a lot more on like financial engineering of sorts at that point in many respects. And early stage, like you have no information. So you're like betting on the founder and you're betting on the vision and the market and the team and the product and all that stuff, right? So none of that stuff I think is all that different in terms of evaluation. I think it's pretty standard stuff. I think the key is it's actually not hard to figure out like, what are you looking for? It's hard to be good at looking for those same things. Like everybody's looking for the same thing. Nobody has the secret sauce of everybody looks at the market size. Everybody looks at the landscape. Everybody looks at the founders, the product, all that stuff. There's no secret sauce in like, what are you looking for? It's really how good are you at identifying those same variables that everybody's looking for. And by the way, that's where there's a lot of like price, dislocation. That's where for somebody, um, Andreessen was really famous for this over the last 10 years, where a lot of venture firms would say, everything Andreessen looks at is super, like they're doing all these overpriced deals. It doesn't make any sense, on and on and on. Um, and, it wasn't super popular when they did Coinbase or Airbnb or, a lot of these deals. A lot of people thought they were overpriced. I would argue it clearly wasn't overpriced, right? I mean, the returns have been fantastic on those. They just looked at it or evaluated it in a different way, right? And that's really the key.
I know we have a minute or so left, but I'm just curious real quick with running companies, investing, Twitter, all these different things. How are you allocating your time? What does that look like for you? I'm just curious. I've talked to a lot of angel investors who some have struggled to do angel investing as they're an operator. Some have done it, before or after. Like, I'm just curious on how you've kind of approached that too.
Yeah, I think if you look at all these things as separate things, then it can be really challenging. And
Yeah.
and candidly, it can be kind of irresponsible. Like if you've taken venture dollars and like you have an obligation to your investors, your employees, et cetera, you can get spread really thin. I think if you look at these things, like I look at them, which is actually they're very interrelated to one another, then I think it actually, and I like a phrase you used earlier, which was this idea of like building things that come to you versus going out and reaching out for them. That's really the key, right? And so the key is like, if you have a Twitter audience or you have a good portfolio or whatever it is, like, yeah, it takes work to get there, right? Like people don't just like hand you allocation in companies or like, you like sometimes you get lucky, but a lot of times, like if you have a bunch of companies that have done well, typically that's not all luck. Like there's some element of skill, judgment, connectivity, whatever that's involved there. I think the key is the only way to do these things is actually to look at them actually as more interrelated. So like if I get to know a founder of a later stage company and I'm saying this can help me in my business or the way I'm thinking through a current problem or so, and oh by the way, we just happen to build a good relationship and I'm going to write a check in. Well, the like getting the help on my issue, making a relationship, and angel investing all happened in that one hour interaction or 2 hour interaction, whatever that might be, right? And so I think the more you actually find a way to tie these things together, the less of a man, I'm spread all over the place and I'm doing all these different things. It
Yeah.
actually ends up being really cohesive in what you're doing. And by the way, I think that's where things actually really compound, right? So, like, for example, if I was like, hey, Twitter is a part of my job and I need to write 10 hours a week and do 3 threads a week and this, that, and the other, like, okay, and on top of that, I'm running a company, and on top of that, I want to invest, and on top of that, I have a podcast, and on top of that, and on top of that, and on top of that, then you get to a situation where you're like, okay, maybe you can do it. Maybe you can work 100 hours a week, or like you're probably going to burn out. Or candidly, like I don't want to work 100 hours a week, right?
Yeah.
And so that's not going to happen. But if you start to think about it as like, okay, well, it's not really stacking, and it's more like interspersed and interwoven. Yeah, you put in a 50, 60 hour week, like you work hard, et cetera. But it turns out that a lot of these things are actually interrelated, right?
Yeah.
And so I think that's really the key. I think for anybody that's looking to like getting into doing stuff like this, which is maybe building an audience, maybe investing, maybe operating, doing all of them at the same time, maybe podcasting. And podcasting, I kind of podcast Twitter, like I think of as like creating. There's the creating
Creator.
content bucket, there's the investing bucket, there's the operating bucket, and I think if you look at those three distinctly, it's very very hard. I think if you look at them in an interrelated way, it's actually, I mean, it's work, right? To be clear, but
Yeah.
it's not impossible by any means. And I think that's why it's also just like one kind of final point is it's so important to be in the game, right? I think there's so many people on Twitter or like this, LinkedIn or whatever it is that, want to talk about it or talk about how do you, manage someone or what's your leadership philosophy or this, that, and the other. And I just say like it's really hard to do that if you're not playing the game, right? Like I think a lot of where the content for me at least comes from is like I'm playing the game, all day every day. And so like I've had to fire people before. We've bought companies before. We've invested this, that, and this. So when there's a thread on like M&A or there's a thread on, hey, how do you let somebody go or managing an underperformer or managing a star performer or whatever it is, like those are things that have actually happened, right? And so when you're writing those threads or you're writing those thoughts, you're not actually spending like 3 4 hours being like, hey, I need to kind of construct an artificial situation, and then what would I do in that artificial situation, and oh hey, here's this great like piece of Twitter content. And maybe that accomplishes like your goal of it gets you followers and this, that, and the other, but it's not a sustainable way to do it. It's a pretty exhausting way to do it, right? I think when you're actually living the game itself, a lot of these things just come out kind of organically. So I think the most important thing is like if you want to build audience, if you want to do all these different things, etc., you know, get in the game. Find a company you can invest in, right? Be an employee at a fast growing startup, start your own thing, make mistakes, whatever it is, but get in the game. And if you get in the game, right, not only does it help you with all those other elements, but other people that are in the game attract to you also, right? And so your peer set or the people you're interfacing with, kind of back to that earlier point of increased serendipity, surface area, so on and so forth. You just increase that because you're surrounded with other people that are playing the game.
Where's the best place for people to reach out to you, connect with you as well if they'd like to, Romeen?
Yeah, I mean Twitter's great, right? Like I try. I'm not perfect at it, but when I put out content or so, or people DM me, I try to respond back. I get a ton of DMs, so I'm not perfect at it, but I try to engage as much as I can. So yeah, Twitter is great. If you want to like my handle kind of in the show notes, it's very simple. It's just
Yep.
my first name and last name, at Romeen Sheth. But yeah, Twitter. I think Twitter is like the internet's town square. So
Oh,
that's the
perfect.
best way to interact.
I love it. No, thank you so much for taking the time to come on the show today.
Awesome. Thanks, Justin. Thanks for having me.